And Bain Capital, the company that oversaw the collapse of America's biggest toy store. What happens when it takes the controls at Virgin Australia? Also on the program, why COVID's put a rocket under the Afterpay share price. When will investors who buy now see their payday? This week, troubled wealth manager AMP continued to hog the headlines for all the wrong reasons. Futile attempts to cover up and then explain away a sexual harassment complaint finally claimed the scalps of Chairman David Murray and fellow director John Fraser, two of corporate Australia's veterans. There are calls for the chief executive, Francesco Di Ferrari, to also go after the alleged perpetrator, Bo Pahari, was demoted to a still very senior role at the company. It's been a disappointing tenure for Mr Murray, who joined AMP in June 2018 as the great big hope after the smashing of AMP at the Royal Commission. But throughout his tenure, AMP has nothing but underperformed the rest of the ASX. His appointment of Francesco Di Ferrari as the great fixer also failed. His turnaround strategy has gone nowhere. Andrew Robertson reports.
At the Banking Royal Commission, no company was shamed more than AMP.
Charging premiums for life insurance to someone who's dead. That's the position, isn't it?
Yes, that's the way the system is treating it today.
In the wash-up, AMP lost 5 directors, including its chairman and chief executive. Just 2 years later, the board resignations are happening again as once more the culture of AMP is exposed.
It's sending a really strong and clear message that AMP is not backing their own employees or the woman involved.
The furore centres around revelations that this man, Bo Pahari, was promoted to run AMP's most profitable division, despite being docked $500,000 in pay after an allegation of sexual harassment was made by one of his subordinates. That prompted a shareholder revolt, resulting in Chairman David Murray, as well as Mr Pahari's immediate boss, former Treasury Secretary John Fraser, both quitting the AMP board. Mr Pahari stays, though, back at a previous level, still earning millions of dollars a year.
What people have heard is very much we place far more emphasis on the people who generate profits or control the generation of profits than we do on people who do the right thing.
AMP has refused to release the report into the sexual harassment claim, prompting the woman's lawyer to warn that she'll continue to speak out.
While there's any suggestion of trivialising or misleading investors and others, she will be, I think, vigilant about making sure the record is corrected.
Also in the spotlight is Chief Executive Francesco Di Ferrari, who earlier this month said he wanted to improve the culture at AMP. However, by keeping a man with such a big black mark against him in a very senior position, there are those who believe Mr Di Ferrari has already failed.
I think he needs to make a very decisive action now or step down himself.
In a statement late today, AMP said the complaint was dealt with appropriately and Mr Pahari was penalised accordingly.
Andrew Robertson there. In good news for official growth figures due in a few days, construction is holding up better than expected thanks to big mining and infrastructure projects. A 7% plunge in June quarter construction was anticipated, but the official figures saw a decline of just 0.7%. But home building suffered a big fall. It's now down 12.1% for the year. Total work is down 2.2%, roughly back to September 2016 levels. It's been trending down since 2018, well before the crisis. US private equity firm Bain Capital is a step closer to being confirmed as the new owner of Virgin Australia. But private equity traditionally is not a long-term owner, which for Virgin Australia raises the question, how long will it stay in the air? Andrew Robertson spoke exclusively with one of the world's leading experts on private equity.
When the United States Congress investigated the private equity industry last year, Eileen Applebaum was a key expert witness.
Most private equity money goes into acquiring large companies that offer few opportunities for improving operations and many for financial engineering.
A highly respected economics professor, Eileen Applebaum's views are in demand whenever private equity is in the spotlight. What sparked the inquiry in the United States was the collapse of what was once the world's biggest toy chain, Toys R Us.
The day before Bain and the others bought Toys R Us, its capital structure was 87% equity and 13% debt. The minute they bought it, its capital structure was only 17% equity and 83% debt.
In effect, Toys R Us paid for its own takeover, and the $500 million a year interest bill on that huge debt sent the struggling company to the wall, throwing over 30,000 people out of work. What does a failed US toy chain have in common with a collapsed Australian airline? Well, the Bain that took part in the takeover of Toys R Us is the same Bain Capital which looks set to get ownership of Virgin Australia. So Toys R Us may give us a clue as to what the future for Virgin under Bain will look like. Starting with Virgin's aeroplanes, of which it owns half. Those planes have been borrowed against, but Eileen Applebaum believes Bain will be looking for an opportunity to extract value from them as the loans are paid down.
But if things begin to recover, you can imagine that Bain would sell the airplanes to a leasing company, and then Virgin Australia will have to rent the airplanes back, and Bain will walk off with whatever they sold it for.
Another money-making strategy of private equity is what's known as the Management Services Agreement, which Eileen Applebaum says will be signed the day Bain takes control of Virgin. The airline will be paying hefty fees for advice and services it may or may not need.
A lot depends on how the negotiation or how that management services agreement is structured, whether Virgin Australia has a chance to come out of this in good shape.
Also affecting what shape Virgin will be in is how its takeover is paid for. Bain is offering $3.5 billion, but if, like Toys R Us, most of that takeover price is loaded onto Virgin's balance sheet as debt, the interest payments will be a big drain on Virgin's finances as it tries to reinvent itself to become viable. And then there's Virgin's boss, Paul Scurrah. On The Business 3 weeks ago, Mr Scurrah was confident he'd be staying in his job.
I've worked very closely with Bain Capital on their plans, and they've backed me and my team to take this airline forward and make it the success we all know it can be.
But Eileen Applebaum wonders how that may unfold, saying private equity owners and incumbent CEOs often have different aims.
The first thing to look out for is, do they replace the CEO? That'll be a warning sign. And who did they replace the CEO with? Is it somebody who knows anything about running an airline? That would be very unusual.
Eileen Applebaum points to Toys R Us, where the CEO installed by Bain and its partners had no experience of the toy industry, which made a bad situation worse. But while she admits she's not Bain Capital's biggest fan, she doesn't blame it for pouncing on Virgin.
They're very aggressive in their use of debt, but on the other hand, nobody wants to give Virgin Australia any money. So it really has no choice.
Which leaves Virgin in the hands of private equity. Only time will tell if Bain Capital will be seen as a white knight or just another corporate raider.
Bain Capital declined the ABC's invitation to be in that report and also refused to answer written questions. Meantime, another 2,500 jobs are going at Qantas and Jetstar as the toll from coronavirus continues to mount. With 6,000 jobs already axed and 20,000 workers stood down, Qantas will outsource baggage handling at all the airports where it's currently done in-house, including Sydney and Melbourne. Last week, announcing a $2 billion loss, Qantas says it can no longer afford to provide its own ground services.
Qantas and Jetstar would need to invest a further $100 million on ground handling equipment over the next 5 years, things like tugs and baggage loaders, if the work is kept in-house.
As COVID casualties in the travel industry mount, Flight Centre has plunged to its first loss since 1982. The company lost $664 million in the full year, down from last year's $200 million profit. But boss Graham Turner is confident Flight Centre will make it to the other side of the pandemic. He spoke to Alicia Barry on Thursday.
Graham Turner, welcome to the program.
Thank you.
You've written a joint letter with other tourism bosses to state premiers, calling them to open state borders. What states are showing the most resistance?
Look, I think it's fairly obvious that there are a few states that for some reason, and you know, they might think they have a good reason, but certainly my view is, and I think that's a view of a lot of different people, different businesses, different communities, is that we're going to have to live with this virus. It's not going to go away just because one state manages to contain it with very little community infection for a few months. It's here for good. A vaccine early next year hopefully will help suppress it, but I think we've got to learn to live with it.
So Queensland, is that dragging the chain here?
Look, Queensland is, but it's not only Queensland. It's WA and Tasmania, for example, as well. Even you know, in New Zealand, which has been a great example that we have to live with it.
Well, you're not expecting leisure travel to return to pre-COVID levels until financial year 2023. Do you have enough cash to hang on until then?
Yeah, we believe we have. I mean, we're lucky because we're a public company. We have the ability to raise a lot of cash. There is a reasonable amount of cash around the world. The people who aren't so lucky, of course, are small businesses, SMEs, and the people who work for them, because it's going to be there's going to be a lot of collateral damage here.
Do you think investors have the appetite to continue to buy up shares if you've got to raise more equity on the market?
Look, I mean, there is funding available. We're very liquid at the moment. We have a cash runway that we're pretty comfortable will last a couple of years with minimal revenue coming back.
When you say you can hang on for a few years, what will you look like at the end of it? How slimmed down will you be, and how many more jobs will have to go?
I don't know exactly that, but you know, we started with 22,000 people globally. We're down to about six and a half now. We can slim a little bit more. We don't want to, and we want to bring back people as the market comes back. And it's a tragedy to see most of the people that we've had to stand down or retrench. You know, young people, 25 to 45, 50, with families and mortgages, and it's just a tragedy.
Well, your accounts show that non-executive directors will return to full fees by the second quarter of this financial year, and that executives will return to 90% of their fixed salaries, still foregoing bonuses though. Is that reasonable in this environment?
Yeah, I mean, that's a debatable point. I mean, I think there's been a lot of pain by the executive team, I mean, in terms of finances, but you're right. There's been a lot more pain by a lot of our frontline people, and it's certainly something that's you know, I suppose at some stage things have to return to some level of normality.
Overseas, where borders are a bit more fluid, are you seeing green shoots?
Yeah, definitely. I mean, you know, there's still a lot of infection around in UK, Europe, but the travel is increasing there, not dramatically yet. They do seem to have a somewhat more progressive attitude than we do here locally. It seems to be, you know, we don't seem to be working like a federation or a national cabinet. We're sort of working like sort of fiefdoms a bit, and it's very destructive for businesses.
It's the tech stock of the moment. Afterpay has rocketed up the stock exchange from a low of $8 in March to a record $92 earlier this week. Where to from here? If you ask analysts, anywhere from $27 to $106 is a fair price. The Buy Now, Pay Later platform has seen a 97% jump in revenue. Customer numbers have been supercharged by COVID, and retail partners continue to grow. But the company is yet to turn a profit, booking a $20 million loss. CEO Anthony Eisen spoke to Alicia Barry.